Good evening, TheoTRADE. This is Corey Rosenblum, and you're watching the Theo, not the video, for the 3rd of October. It's a new month here in 2023. We have another down day in the market, and the bond market was on the threshold or the forefront of the selling. All sectors are down except the utility sector, which is often a safety spot in the market. But in tonight's video, we will focus on the continued push to the downside as discussed a couple of weeks ago before the Fed. And the surprise from that video was going to be to the downside because of inflation and the Federal Reserve keeping rates higher than expected for longer. And that has changed the dynamic and changed the balance of the equity market, has sent it lower. The bond market has sent it lower. But the easier way to see this as the Fed combats inflation, and they've had to shift a little bit more to the hawkish side, means more combative side, that has sent interest rates higher very, very quickly. Let's start there. So one way to look at inflation is oil and other commodities. We also look at the CPI, the Consumer Price Index, the PPI, the Producer Price Index, and of course other rates of inflation. One of which is a quick note is oil. So not long ago, at the end of May into June, oil was at 52-week lows and down at the lower bound of its support levels in 2023. A price level not really seen since 2022 or so. And that was good for the economy as gas prices and general inflation was going down. The numbers were trending in the right direction. But that all shifted in July into August and September. So that right there, the reversal off of about 70 per barrel and the continued violent, quick, rapid upswing in oil led the Fed to adjust their trajectory. And they had to make statements about raising rates or at least keeping rates higher for longer. And as inflation became another big bump on the radar, a little more than a bump on the radar, Fed funds rate and the expectations for future Fed funds rate were higher. And again, they made their shift in the most recent 2 weeks ago Fed. And their announcement was that not only will they probably not cut rates to the extent that people were expecting, but they will keep rates higher for longer into 2024. And will reserve the right to raise rates at a future meeting, perhaps November. So that is the shift that has sent shockwaves through the financial markets. And I like to summarize it as higher inflation. Fed combat inflation by raising rates. Rates travel higher or are pushed higher. Right behind that is the bond market. We'll take a look here at the 10-year Treasury note. Has continued the downtrend and the downward trajectory. And again, we'll look quickly at the TNX just to compare. There's your weekly yield. And on the bonds, 30-year bonds, they've made new lows as well. Not just made new lows, but they've dropped out the basement or fallen through the first floor and are making their way down to the basement levels. But that is in conjunction with what we're seeing and have been seeing in this continued fight of inflation from the Federal Reserve. And the bond market has gone lower and the yield market has gone higher. And if we look a little bit outside of those technology stocks, the market itself has gone sideways and now down. So I like to look at the Russell. Been highlighting this in my sessions and in the videos. And the thought is that the economy is neither bullish, we can agree on that, but the economy is not very bearish in terms of GDP, consumer sentiment, and the employment rate. We can't really call it bearish or a bear market, but it cannot be called a bull market. At a minimum, it's stagnant, and I call it the market that's muddling through. Neither bullish, not really bearish, just getting forward as best it can. And I think the Russell and perhaps the Dow shows that the best. And they just continue from 2022 to be in a sideways trading range which gives us short or bear opportunities when the market is above the fair value, at least for the Russell, that's about 1900 in the index product, and around under fair value is about 1750, which sets up long or buy positions. The Dow Mini Future shows something similar with its ongoing sideways, but it is the Nasdaq and that tech and AI, artificial intelligence, hoopla or hype that has, or optimism or hope, that has sent certain stocks much, much, much higher than their valuations would suggest, similar to the tech bubble of 1999. But the Nasdaq is on the forefront of some of those stocks, and the S&P is being pulled with it. But again, with this most recent sell-off from 4,700, the S&P is taken down to 4,300, which is not that different in the context of its trading range. And as we look at sectors, that's what we'll focus on tonight too. Again, the economy muddling forward and the sideways action in stocks turning more bearish with the Federal Reserve and the liquidation or selling that is getting monstrously large and dropping lower in the bond market and to an extent equity markets as well. So as we take a look at our sectors, the financial sector, we'll look at I'll draw your attention over to the right, which is the weekly chart sideways, and the daily chart, which shows the 2023, again, sideways. Not much to speak of in financials other than short or bearish positions at the top of their range and long or bullish positions with the midpoint or the fair value being around $33 or $33.50, maybe even $34 for the fair valuation. We'll skip the K and the Y straight to industrials. Again, better to see this as a trading range market, not a bull, but also not a bear. We've just been brought back to where we were at the earlier part of 2023, which is back to that 100 per share value for industrials. And if you ever want to step inside some of these broader ETFs or the sector ETF to see which stocks might be tradable, you can look directly here at the Analyze tab and type in your XLI or XLB, E, Staples, etc. And then you can see what are the leading components in that ETF. Caterpillar, Union Pacific, Honeywell, GE, just to name a few in the industrials sector. B is going to be materials. You can see some of the trade logic and trade outcomes from a long from beneath and a short from above fair valuation at about 80 per share in the materials sector. Some of the leading stocks there could be Linde, Air Products, Sherwin-Williams, Freeport-McMoRan, and others. We do have the short in the energy sector, and that's just down from the top of the range, $93, $93.50. And that does have a downside target to fair value at 86. That's your ETF. And again, stocks in that broader ETF are weighted to the major side on ExxonMobil and CVX. A quick look at those will show ExxonMobil had a similar sell swing or top of the range bearish play, and then CVX is a little bit of a different place on its daily chart, which has it toward the middle of the trading range. A little bit of a difference in those two, but nonetheless, we like to look at the sectors to make those decisions. Moving on to the XLP, which is Staples, that's at the lower bound and is negative on the year. So Staples and some of the staple stocks are actually showing consistent weakness and underperformance, and they tend to make repeated 52-week lows in ongoing downtrends. That includes Cisco, Dollar Tree, McCormick, General Mills, ConAgra, Campbell Soup, and the chocolate company Hershey's, but also the jam company Smucker's. And a quick look at these stocks in today's session. 62 stocks in the S&P 500 made fresh new 52-week lows and are showing relative weakness to the broader market. And the other things to note is that utility stocks consistently show up in this weak getting weaker list. We'll see that momentarily. And of course, real estate as a sector, and these are highly influenced by the rise, I would say rapid rise, in interest rates. Utilities are being sold, as are real estate companies. So back to Staples, which is XLV, or V is healthcare, Staples XLP, V is healthcare, and we'll finish up with XLU, which as interest rates go higher, a lot of investors will use utilities as a bond-like product that shows safety relative safety, not a lot of volatility in the XLU or utility stocks, but they do generate attractive yields or dividends. But when the yield on a treasury bond is higher than, in some cases, 1% or 2% higher than the utility sector, then why not take the money out of the utilities and the volatility and the risk of utility sector stocks and then put that over into bonds, which will yield a consistent return, but without the volatility. And that is in part why utility stocks are on the sell side, have been weak through the bulk of 2023. And many of them, including NE or Next Era Energy, have taken a persistent sell swing in the most recent few weeks. And a few other stocks would fit the bill of NE, Southern Company, Duke Energy, and we have Sempra and others on the list. Again, to look inside of ETFs, just jump into the Analyze tab and look within those sectors. Today is going to be the last day for our ticket to get your hotel room booked for the TheoTRADE upcoming event taking place in just exactly a month. And that's TheoTRADE.com/23. Just going through here, and I want to highlight what the significance of today's market session is. All of the instructors, all of your fellow team members here at TheoTRADE, but why we are interested, because the cutoff date is Tuesday, October 3rd for making reservations to get that discounted rate right here, TheoTRADE.com/23 for our live event. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for October the 3rd, 2023.